I mean, I've shared my point of view for a couple of years now. I think the US is in a, call it subconscious conflict escalatory state that would continue to drive us into these sorts of
It's great for markets.
conflict. Seems to be.
Great for markets.
Conflict is great for markets, you're saying?
No. The fact that it seems like there's a terminal outcome, and all we're debating is whether Zelensky sees it is actually very reassuring for the market.
Oh, you think the markets are recognizing that there may be an end to the Ukraine conflict?
Well, I do think in part. I don't think it explains why it's up necessarily today. I think that's more because I think I mentioned this before, but the end of the fiscal year for mutual funds was October 31st, and so there was a lot of selling going into October 31 just to capitalize tax losses and tax loss harvest. But that leaves them with a lot of cash. And so starting November 1st, which is day one of the new fiscal year, mutual funds are not allowed to really own cash. That's not why you pay them. And so they're going to be active buyers. So that's why in the short term, the market is up. But if you think about the overhang of risk that we've had, right? You had one forever war and now the beginning of what potentially could be another forever war. That's definitely a dampener on market demand, right? And sentiment and investor confidence. But if a story like this is true, it actually takes one of those big risks off the table, which is this idea that now it's like every other kind of a thing, which is it's the reason we spend money there is not to win something that's winnable. It's just graft. It's just typical corruption.
Total graft. And the article says that, you quote a Ukrainian official saying that people are stealing like there's no tomorrow.
Right. So that the U.S. unfortunately enables in many places. That's not new. And so to the extent that that's now more of the status quo, that's reassuring for investors because we're not talking about a war. We're just talking about bleeding more money, which I'm not saying is right, but it's morally more acceptable than the alternative. So there you have it. It's generally good for markets. Now, that leaves, I think, Israel-Gaza as a risk. And I think the markets still view that as a potential war. And the longer that goes on, I think that there's a very good chance that we de-risk that as well as, again, not a war, but part of that cycle between Israel and Palestine, which is conflict, timeout, conflict, timeout, conflict, timeout. And so if what we think is now, this is just a version of conflict, timeout, and the market de-risks that, then it's actually pretty positive for equities, for startups, because now the Fed has a reason to actually say, okay, the economy is cooled off, inflation is calm, it looks like the markets are stable, let's cut rates, right? Let's reintroduce some demand into the market. It's generally a good thing. And if there's no reason to be risk off, people will use that as a reason to be risk on.
Yeah. Well, Treasury yields, the 30-year
cracked.
It's down
cracked.
15 bips.
2 days.
40
bips in like 2 or 3 days.
Yeah. So
don't you think this is because the forecast or the outlook for Q4 or Q1 next year, it's starting to go down quite a bit? That people are starting to see more recessionary indicators? So you had this like peak 4.9% growth rate, and then inflation seems to be tamed quite a bit too.
I think, to be honest, the look through on Q1 looks also pretty good, and Q4 looks healthy as well. So, for example, Shopify, their read through on GDP was actually pretty healthy. Harley was on, I think it was CNBC I saw this morning, basically saying he thinks consumer spending is still strong and it's still there. So I think in terms of just like economic strength, I think it's pretty decent, actually. I think what changed for the market was the Fed's rhetoric. And I think that they were holding on to this option that they were going to show up out of nowhere with another 25 or 50 basis point increase. And I think that that's fundamentally now off the table. And I think that that's really heartening for the market. That's good for the market.
Growth stocks are ripping. Affirm and Palantir are up 20% today.
Ripping. Yeah. Open Door, ripping. DoorDash, ripping. All these companies are up 20 and 25 and 30%. It's crazy.
Yeah.
So are we calling bottom, Sachs?
Well, maybe. I mean, I don't know. It's so hard to predict the markets. But if you believe that there's more upside to rates than downside, meaning that the odds of a rate decrease are much greater than the odds of a rate increase from here, then there is upside to valuations, particularly for growth stocks, also for distressed real estate, because all these things get more valuable when rates are lower. So if you believe that we're going to be in a cycle of rate decreases and that whole thing has played its way out, then everything's going to rally.